The debate between the gold standard and fiat money is not a moral argument about honesty versus deception, not a simple story of American dominance on a helpless world. It is, at its core, a structural problem of how modern economics grow, trade, survive under persistent imbalance. Once you follow the logic step by step, the abandonment of gold stops looking like a conspiracy or a betrayal and starts looking like an inevitability produced by scale, asymmetry, and political survival. Another classical gold standard of the 19th century and early 20th century, money was directly or indirectly convertible into a fixed quantity of gold. Exchange rates were fixed because each currency was defined by a gold weight. This system imposed an automatic balance of payments adjusting mechanism. If a country imported more than it exported, gold flowed out to settle the deficit, and that gold outflow reduced the domestic money supply, tightened credit, lowered prices and wages, and pushed the economy into deflation. In theory, cheaper domestic prices would restore competitiveness and correct the deficit. Conversely, a surplus country generated gold inflows and expanding monetary supply, rising prices, and declining competitiveness. In theory, inflation would reduce exports and rebalance trade. On paper, this mechanism looks elegant and self correcting. In reality, it was brutally pro cyclical. Deficit countries were forced to deflate prices precisely when they were weakest, producing unemployment, bankruptcies, and social unrest. Surplus countries were pushed towards inflation or forced to sterilize gold inflows through high interest rates, which choked domestic growth. This system imposed pain on both sides of the imbalance, just in different forms. There was no neutral outcome. Adjustment was not smooth, it was recessive by design. This is the crucial insight that explains why gold backed systems repeatedly collapsed. Economic growth, industrialization, and global trade expanded far faster than the physical supply of gold. Gold production grew slowly and unpredictably, while credit demand expanded rapidly in response to population growth, technological change, and global integration. A monetary system tied to a scarce metal simply couldn't scale with the real economy. Each expansion cycle strained the gold constraint. Each contradiction amplified downturns. The result was repeated crises culminating in the interwar breakdown of the gold standard and the Great Depression. The attempt to revive a modified gold system after the Second World War through the Bretton Woods framework was an effort to preserve stability while introducing limited flexibilities. Under Bretton Woods, currencies were pegged to the US dollar and the dollar was convertible into gold at a fixed price. This arrangement rested on unique post-war position of the United States, which held the majority of gold reserves and dominated industrial production. For a time, the system worked because global trade volumes were still manageable relative to gold holdings. By the late 1960s, however, the contradiction became impossible to ignore. US spending on war and domestic programs expanded far beyond its gold backing. Dollars accumulated abroad faster than gold could support. Foreign governments realized that full conversion was mathematically impossible. When France and others began demanding gold instead of dollars, the system faced collapse. In 1971, Richard Nixon suspended gold convertibility, ending Bretton Woods in practice. The decision didn't create fiat money out of thin air. It acknowledged that fiat money had already become unavoidable. The key point, often misunderstood, is that countries didn't meaningfully agree in a deliberative sense. They adapted because the alternative was a systematic breakdown. In 1971, global trade, reserves, and financial constraints were overwhelmingly dominated in dollars. Central bank held dollar assets, private firms invested in dollars, and international credit markets relied on dollar liquidity. A collective rejection of the dollar would have vaporized reserves, frozen trade, and triggered a global depression. The choice, not between gold and fiat in the abstract, it was between continuity under a fiat anchor or immediate collapse. The idea that countries could simply return to gold individually ignores the coordination problem. In a world where most states operate fiat systems, a single gold-backed country faces severe disadvantage. Its money supply becomes rigid while others remain elastic. During downturns, it cannot expand credit to stabilize output. During capital flight, it must defend its gold reserves through higher interest rates and austerity. Speculators test the peg precisely because they know the constraint is finite. History shows that such pegs fail repeatedly not because gold lacks value, but because fixed constraints are unstable in an open, high velocity financial environment. The same logic explains why lending in gold is not a viable substitute for fiat currency. Modern credit systems depend on elasticity. Banks create money through lending and backed by expectations, collateral, and state guarantees. The gold lending requires physical transfer of a scarce asset. There is no meaningful multiplier. In a crisis, gold cannot be conjured quickly to prevent collapse. Fiat systems can inflate, refinance, and roll over debt indefinitely, trading long-term stability for short-term survival. Government consistently choose survival. This brings us to the apparent paradox of global debt levels approaching or exceeding global GDP. Under fiat systems, debt is not an debt is not an anomaly. It is the mechanism through which money is created. Every financial asset is someone else's liability. The system doesn't require repayment in aggregate. It requires confidence that obligations can be rolled forward. Gold-based systems impose hard repayment constraints which convert financial stress into immediate economic contradiction. Fiat systems defer reckoning at the cost of periodic inflation and asset bubbles. When viewed through this lens, the end of gold was not primarily an act of American domination, though it certainly entrenched American advantage. It was a recognition that metallic discipline and modern mass economies are incompatible. Once global trade reached sufficient scale, any system requiring universal deflation adjustments was politically and socially unstable. Democratic states cannot repeatedly impose mass unemployment to defend a metal peg. Authoritarian states face legitimacy risks when living standard collapses. The result is the same abandonment of the constraint. The post 1971 dollar centered system introduced a new asymmetry. One country gained the privilege of issuing the primary reserve asset, allowing it to finance persistent deficits without immediate punishment. Others gained access to liquidity and growth, but surrendered monetary sovereignty in practice. This arrangement is unstable in the long run, but it has endured because no alternative system yet matches the dollar in liquidity, legal infrastructure, and enforcement capacity and network effects. In the final analysis, the conclusion can be no one wins under a gold standard adjustment mechanism. Gold enforces discipline symmetrically, but that symmetry translates into shared pain rather than shared prosperity. Fiat systems replace discipline with discretion, allowing growth and crisis management at a cost of long-term distortion. History shows that states consistently prefer discretion power over mechanical honesty. The abandonment of gold was not a rejection of value, it was an admission that modern economies cannot function under a system that treats recession as a primary adjustment tool. The unresolved tension remains. Fiat currency postpone adjustments, they do not eliminate it. Gold systems force adjustments immediately. Every monetary order chooses where pain appears and who bears it. The gold adjustment concentrated pain in employment and wages. The fiat order concentrates pain in debt accumulation, inflation risks, and financial instability. The world didn't choose fiat because it was cleaner or fairer. It chose because under the constraints of scale, politics, and human tolerance, it was the only system that allowed continuous expansion without repeated collapse.